call about we're going to start off pretty much explaining basic things of my methodologies in terms of structural ways of reading the markets. Now, as you all know, we have pretty much previously gone through the core ideas of my methodologies. I just also wanted to touch upon the new channel added in, and if everybody just scrolls up a little bit, um, if you scroll up a little bit, you'll pretty much be able to see a new channel here called My Basic Methodology. It's more or less what I base all my trades on and what I base everything I do in the markets on. That is creating a model. That could be pretty much going into bias. That could like how I think the market should perform. Um, what I more or less think of when looking at the markets. It's just all here, right? And the core ideas we have specifically mentioned, I'm just going to repeat myself here, but it's pretty much engineer liquidity, time-based liquidity. That's the two major topics we're going to go through, but that's not the only things I use, of course, because I also use normal average day ICT concepts. Then I also use market correlations, market cycles, COT and seasonalities, and specifically statistics and data. And statistics and data is the most important code. And now I'm gonna try to organize my things a little more so everybody is able to, watch the specific statistics and data videos. So I'm pretty much gonna try to organize my YouTube videos in which the course is specifically about data and how you collect data, why you collect this specific data, um, how you create a model, etc., in accordance to data, um, and etc., just moving on, etc., from there. So everything about the statistics specifically and data, right, in one section, right? And I'm gonna add it into my basic methodologies here. And then also, of course, how I analyze COT and seasonalities. You have the new call out. I dropped it 2 days ago, and it's an actually simplified version of my student charter calls. So I actually pretty much made it public a little bit, but it's totally fine since I've cut off majority of the meat in that specific call. But then of course we also have market correlations. I'm not going to cover it at all in this call. I'm just going to stick to the basic core ideas of liquidity in this call, talking about what specifically I think about liquidity, how I use liquidity, and why it is actually one of the major points in my methodologies. Like, why am I specifically focusing on liquidity that much and not some other stuff like fair value gaps, order blocks, supply and demand, or whatever, anything in the markets? Why specifically liquidity, and why is it a core principle in anything I do that is bias, developing a bias and analyzing the markets, or creating any specific model? All right, that's just a core principle. Now we have two different liquidity types, or I just base them on, what I talk about, right, and how I define liquidity, and I define it in different ways. And I'm not gonna specifically talk about why it works, how it works, etc., in today's call. And of course, is engineer liquidity and time-based liquidity, and that's just core principles, core ideas. All right, some things I just stick to when I do everything in the markets or anything in the markets, right? So yes, this call will be recorded, so don't worry about it. Don't worry about it. Let's just dive right into this specific video or this specific call, right? And of course, we're also going to cover an in-depth analysis of this. I'm not going to pretty much do it real as in-depth, but we're going to still do an in-depth analysis after we've rounded up this call. So don't worry, guys. We're going to do an in-depth analysis after this, so you guys are prepared for what I think will happen in upcoming weeks. Such are my thoughts, but I'm also, of course, going to tell you why I think that is. And what I just wanted to start with, like, before I even go in and show some examples of these things, etc., is just to uh, to put like the emphasis on percentage based, like what I do, right? Of what I base my analysis on. And majority of what I base analysis on is actually fundamental. So it's like 70-30. So 70% I base it on what what the externals is telling me, right? Externals, you could say it's fundamentals in a way, right? But you don't necessarily need to worry about that. And it's not fundamentals per se, but just tell you guys it's fundamental, since that's pretty much what majority of y'all would call the things externals is, right? But um, I put like 70% emphasis on fundamentals in my determination of long-term, intermediate-term bias, and short-term bias I just base fully on structural manners, right? So for me to know where the market is going long-term and intermediate-term, like the overall extensions of price, the distributions of price, for me to know where the distributions is going to be, I use fundamentals, right? But for me to locate exactly the turns of events and how it's going to play out, I use structure manners of the markets. So I cannot pinpoint. I can tell you if the market is bullish or bearish fundamentally, but I don't know when it's going to turn. I don't know when the structural shifts in the market is going to occur based on just purely fundamentals, right? And I also, of course, also confirm those fundamentals through CLT, dark pools, and seasonalities, just through a more probabilistical manner. But that's just analysis, right? And I've also said we're gonna do a distinction between an bias, an analysis, and model, right? That's something we're gonna talk about as well. But let's just dive right into this specific video. So, starting off with a core things, and that is just liquidity. So when I analyze the markets, all right, I more or less have the belief that I'm looking for, since based on my methodologies, right? I think the market pretty much works or needs to abide by the laws of the universe, right? And specifically that is trying to always find an equilibrium. Now, if it's imbalanced, right, it could be imbalanced in many different types of ways, right? But one of type of imbalance is, of course, rate imbalances, etc., etc. Meaning there is a like real differential of fundamentals going one way and the currency going in another direction, right? And when they're pretty much when they're going in different direction, both of them, that creates a real imbalance, and that pretty much means that the currency needs to rebalance the imbalance, right? If that makes sense. Meaning, let's say right now, I'm just going to take a real time example of this. Right now, we have fundamentals pointing towards a super bearish USD still, right? Still, right now, it's just pointing towards a mega super bearish USD. But yet, the USD has still continued upwards, right? From where the fundamentals is pointing USD to be, right? Because USD should be down in here, right? According to fundamentals, right? But for me then, since it's trading away, it creates a real imbalance, meaning we have like the markets, right? Trading away from it, meaning we should be down in here, but we're not, meaning there's a real chance of us rebalancing this price right here in accordance to where we should be looking at fundamentals, right? Or what I call externals, right? However, what's the major distinction is I cannot pinpoint this thanks to fundamentals alone. This is why I use structure manners in the markets. This is why I use, liquidity. Because using liquidity, and specifically using liquidity, I can pinpoint where the reversals is going to be in price, right? Which is really interesting and really useful. Now, how I'm doing this is simply, as I've previously explained, I believe that the markets needs to abide by the laws of the universe, right? I always trying to find an equilibrium. Now, one other equilibrium basis is trying to follow, based on imbalances and real imbalances, is liquidity imbalances, right? And a liquidity imbalance is just something you can spot on the charts, right? That's something ICT have gotten totally right. And that's that the market is always trying to be at the most liquid state. Or I think the market is always trying to be at the most liquid state. Meaning I think the markets is going for where the majority of the liquidity rests. Since liquidity, the market is always liquid, at least FX, it's always liquid. Liquidity just simply means how easy an asset is to buy or sell at any given time, right? But it can be different. It can be a different difficulty at buying it and selling it at different periods, right? So you need it to be the most liquid, or some people need it to be more liquid at other places and less liquid at other places. And for them to be more liquid, they need to liquidate a lot of people, or they need to make it easier. They need to make both hard stops and not non-hard stops, right? Because not everybody is trading with a hard stop in the markets, meaning some institutional players is pretty much not positioning the same way as we have thought of positions of they don't know how really stop loss. They're like a loose stop, right? Where you know it's pretty much the volatility of the markets, for example, which decides when they're out, etc., etc. But that's why we have manipulations as well. So based on that, we know that the market should always try to be at the most liquid state, right? This is just a basic core idea, right? So since we have that already established now, we already know that the markets is going from the most liquid state to less liquid state to most liquid state. And it's going from pockets of liquidity to pockets of liquidity. Now, and I can just showcase this here pretty quickly, but you can see here, and this is of course in a fractal manner, meaning pretty much this is on higher time frames to lower time frames, right? But in simple facts, you can see right here. Right here, we more or less saw price consolidating until we took the sell side, major sell side time-based liquidity down in here. And over here, we called out for an low get a sell into the markets, right? Because we have then taken out all, on that given time frame, right? We have taken out all given liquidity here on one side, resting on one side of the markets. And so we only have liquidity resting on the other side of the markets. Now, another thing we need to just take in consideration is that the low here is not where all the liquidity rests. It's below the low and the volatility below the low, which causes the people to get liquidated, etc., etc. Now I'm not going to go into detail how I confirm this theory, etc., etc., because that's something which people, or I think majority of the people here already know at least. If you have not already watched the previous calls, please do so. Right, I'm pointing out towards specifically students here, since I talked about how COT confirmed the theory, etc., etc., and how it's always confirming this theory, and that's why we're looking at COT overall. And like I said, it's just confirming the theory. So we don't use COT for bias, etc., etc. I just use it to confirm different theories I have in the markets, right? Um, since I can actually see, the change in orders, right? The commitment of traders reports. I can see what the seasoned traders is doing. I can see what the central banks is doing. I can see what the hedge funds, pension funds, etc., etc., is positioning themselves is. Not specifically in FX, but now we talk about NQ and NSH, etc. You get it, hopefully. Now a similar idea here, where we are overall, where I have an established bearish bias here, right? I'm bearish in the markets, both fundamentally but also structurally now. And that's just simply because, well, we have taken out majority buy side here. You can see buy side here, right? And once we have pretty much taken this out, right, as you can see, and since I don't believe necessarily the buy side is resting just over this high, just at this high, like many people think. This is why, like, if you see a pip of a sweep, the market can still go over that pip, and it could be like equal to a liquidity sweep. Now, I believe also that for it to be a liquidity sweep, we cannot see a sweep of a high directly. That would be a break of structure. We need a high to engineer liquidity, and this is why I specifically talk so much about engineer liquidity. Engineer liquidity is just the amount of liquidity resting at the specific high, right? Oh, thank you so much, Logs. Thank you so much, bro. Real nice. Real nice. Thank you so much. Real nice of you, bro. Perfect, perfect. Anyways, continuing here, like I said, we're gonna cover engine liquidity, like I said as well, later. But I just need to establish this just theory for everybody, my methodologies, how I think of the markets, how I think of a structural manner in the markets, right? I'm gonna talk about basic ICT concepts here as well, which is also something I use. But yeah, like I said, and high here, the liquidity here does not only rest over this or at this high specifically, right? It's not like retail thoughts. This is what is exactly the thing retail thinks. They think, oh, institutions have stop loss over this high. But it's not really hard stops. They have they're looking at levels, right? And they don't necessarily have hard stops. Instead, they're pretty much changing with volatility over here. They got stopped out over volatility over the high, and they have a pocket of where they overall, have need to change their positions, let's say, and that goes over this high, etc., etc. So retail thoughts. Oh, at the specific high, you have liquidity like this. Not really, right? You have over this high, you have the liquidity, right? And the liquidity can rest like this. I don't know if you ever looked at the heat map, but you can definitely see it if you're looking at heat map, by the way. But I don't think heat map will help you because you can see this with using just simple candlestick, right? And that's why we could pretty much deliver up higher a little bit further and then start delivering all over, since we had a clear liquidity. Now, in simple way you can actually use this is by using simple institutional price levels. You can use this for searching institutional money, right? Because they usually have it like 20, 50, 100 pips over this, right? And to establish the next primary level, like this, for example. So I have big figure, mid figure, low figure level. We have talked about this a little bit as well. Institutional price levels, but I don't specifically use that so much, but you can think of it if you want. I'm just giving you guys some ideas here. Now, overall, as you can see, we pretty much after we took out this buy side liquidity up here, we more or less swept out both buy side liquidity here and buy side liquidity here, meaning we left no alternative, because the most liquid state price could be at is pretty much at the significant lows here and here, right? So that's why I'm structurally bearish, right? We have seen price start to deliver down lower, and we have taken out all buy side liquidity here, as you can see, and we're pretty much about to deliver down lower. I would personally say we're going to talk about this later in the in-depth analysis, but since I believe my price is going for the most liquid state, I believe price needs to deliver to the significant lows and take them out for price to be freed up and deliver to other significant highs or lows. It depends on what the fundamentals say. Meaning fundamentals gives me the structural manner of where we're going long term, but the structure matters in terms of where price is allowed to go. All right, that's exactly what the liquidity provides for me. Now I can give you guys an example here. Let's say we have a high basis right here and a low basis priced in right there. We sweep out this high, we cleared then all buy side liquidity, as you can see here. Then we have two significant sell side liquidity pools. Since fundamentals here potentially are bearish, right? I don't know if they're bearish or bullish, but let's say they're bearish here. We need to deliver down lower. We need to deliver down lower for the sell side right here. Take the sell side out for price to now, at this point, when we have taken out this and this, potentially, change directions. Since if we were to deliver up higher here from the fundamentals, that would just create a bigger imbalance, meaning you would just wait for positions lower, right? Or institutions would position themselves lower for the markets to then turn over, since they have the changing volatility of money, and then you're pretty much gonna have this two sell side liquidity points getting taken out. Now, once you have these two sell side liquidity points, you're gonna have new fundamentals priced in, right, already. And the new fundamentals can already be priced in here. This is what I'm trying to teach you guys. The new fundamentals can already be priced in here. But, like, here, the market could be bullish. But since the market cannot just suddenly turn, since that would be breaking the laws of the universe, right? How can it theoretically turn without big people having the change in first, right? They always need the change in first. So they need to take out the significant sell side liquidity points for them to then potentially change the markets, right? If the fundamentals has, changed. This is why fundamentals always change before, but this is also why the structure liquidity manner gives me the structure shifts in the markets and helps me to determine when we're going to see highs and lows price into the markets, right? It's very simple. So that's pretty much my methodologies. This is how I look at liquidity, etc., etc. Now let's go into the two most specific liquidities, right? Engineer liquidity and time-based liquidity. And as I previously said, right, for us to have reversals in the markets, we need major liquidity points to get taken out. But for major liquidity points to get taken out, we need them to form in the first place. Now, this is what I call engineer liquidity. All right, the market is trying to engineer liquidity here, right? And a specific example could be when fundamentals are mixed, right? And when fundamentals are mixed, what the market usually does is just two-sided things. You can see it right here for the currency for pretty much 1 year, right? Where we pretty much saw stagnating rates, and we saw interest rates pretty much stagnate here. And so price just consolidated for a big all while engineering both sell side but also buy side liquidity. And look what we ended up doing later. We swept that, traded up, swept that. Now we're going to trade a little bit lower. And this is, the crazy part here. What I showed you up here is exactly the thing I'm expecting here. For us, now to have a change, but because you have to realize, fundamentals are different. It's also fractal, right? So you have long-term fundamentals in play, but also short-term fundamentals in play. The short-term fundamentals tell us we're going to be bearish here, right? And the structure matters also tells us it's going to be bearish here since we have taken out all buy side liquidity here for USD, right? So I'm trying to teach y'all in-depth analysis while I'm teaching y'all the concepts, right? But it's very freaking simple, right? Since the long-term fundamentals are then bullish, if you think about it, I cannot go into detail why they're bullish. I'm going to talk about that later, in the in-depth analysis. But I'll just tell you, I think they're bullish. I don't know yet because they're not priced in, but I think they are to be bullish later because, also for a structure manner, you can see we're pretty much going higher for euro always. Foreign currencies is going higher. Dollar is always going to go lower. It's going to go to pre-pandemic levels, meaning 2018 levels for the dollar, I think, in the long run. But for us, we cannot just deliver up higher here, since that would pretty much break the laws of the universe. I would say, like the break the laws of physics, right? For us to then have the major shifts coming into markets, we need major liquidity to get taken out. Do I think the sell side here is bigger than the buy side in markets? Well, if you're looking at it, and we can go into 50-minute time frame and look at like where we have the majority of equal lows and engineer liquidity. Well, my rules state that where we have the most equal lows, right, that's where the market pretty much is going to deliver to. Now, since we have taken out buy side here, as you can see, we don't have any equal highs over here on higher time frame basis, but we have crazy equal lows here on sell side, right? So we need then for the markets to price in a change. Like we cannot just deliver up higher through the long-term fundamentals. We need to first trade lower to pretty much take out the pool of liquidity, making price more liquid for price then to potentially price in a change. We don't know if it's going to price in a change because we cannot see that far in the future, but at least it's more probable. And this is why we go into statistics, etc., etc. Since if you pretty much collect data on this, if you're pretty much trying to research these things, you're going to realize that probabilities, you can never say if the market is going to go in one direction or the other direction. The market could go up higher, right? It's like still, even though I told you guys it would break the laws of the like laws of physics, it would not in reality, right? Since everything is based on probabilities. But what I mean is that if we always would do this, if the market always would act like this, that would break the laws of physics. Since the pretty much we're always doing mathematically what's most probable. Since we know statistically, or this is why I need you all to come up with some statistics for this, for occurrence of this. But since we know that statistically we have a pretty much higher rate of occurrence for downside pricing in the changes, right? So pricing in taking sell side liquidity here, right? I'm more or less leaning towards a bearish bias compared to a bullish bias. But you also, of course, always need to have, uh, two plans in the markets, right? You always need to have if it fails and when it's failing, etc., etc. So you need to know if your bias is failing, but you don't lose money on the bias, and this is what we're going to cover later. So this also goes into the other things we are to discuss, right? Yeah, but engineer liquidity, let's go into it. So hopefully this answers some of your guys' questions, at least for structure manners and how I think and how I pretty much uh, more or less in a probable basis, this is how you can predict where price is going based on just pure liquidity, right? Now, where can you see where the liquidity is resting, right? Where majority of liquidity is resting? Well, it's simple. Well, I would personally say the obvious key levels is where the liquidity is resting. Now, the obvious key levels could be, of course, specific highs at specific levels. So it could be, for example, this right here is very close to here. So we have liquidity here. But where you see the market reacting, like forming equal highs, equal lows, right? It's forming equal highs, equal lows for a reason, if you think about it, right? It's not that it's just forming equal highs, equal lows and having a reaction of those specific levels. Or it, of course, could be to some extent random, because all I'm saying is just to some extent true and to some extent wrong, right? You got to research to what extent it is actually right, and this is where you have to come up with your own theories and establish your own things, right? Interpretations, etc., etc. But at least for me, I believe that on a probable basis, if we have something reacting to something, right? We don't know. Like it could be a key level, it could be institutions seeing something, it could be whatever, right? But if we have a market reacting to something twice or three times compared to once, I think it's higher probability for it to be more liquidity resting at those specific key levels, since key levels, I believe, is equal to more liquidity resting at those places, since, it's obvious place. So having equal lows, equal highs just means we have simple, and this could not be only equal highs, equal lows. This could be trendline liquidity. This could be any given pattern, this could be um, more or less you just seeing, uh, consolidations at the specific point. This could be you seeing sweeps at a specific point, but the sweeps pretty much never take out the specific low. Volatility coming into your market, just something which points out the key level in the markets. Now, if you have all three, or if you have more than one of these characteristics, more one of these dominoes, right, you will have a higher probability, other than a normal high sell in the markets, like compared to a normal high sell into markets, that is actually significant, and that those specific levels holds liquidity, right? Or more liquidity than the other levels. And so that's pretty much why equal highs, equal lows, or just trendline liquidity in general, or any given pattern, etc., I believe holds more liquidity at those specific places. And those liquidity points, therefore, is then used, in terms of my methodology, uh, because I'm looking for a price to gravitate towards those levels, meaning drawn liquidities, right? I use those for drawn liquidity places. This is how I analyze the market. So for example, right now, I'm seeing equal lows, equal lows. I'm seeing equal lows. I'm seeing trendline liquidity here, meaning fulfilling pretty much all of the objectives I've set out to achieve if the market is going to drop. So I believe the market is going to drop, right? That's pretty much how I get my buys. Hopefully that helps you guys. Now, what is the difference between engineer liquidity and time-based liquidity? Well, time-based liquidity, on the other hand, is just liquidity based on time. And that's also pretty much going into detail about engine liquidity, because notice what I've said. I said it's pretty much specific levels in the markets, right? Now, specific levels can also be based on time, right? Now we're not talking about macros, etc., but previous daily highs, previous daily lows is also key levels, and previous weekly highs, previous weekly lows is also key levels in the markets, right? Since it closed there for a reason, right? It's pretty much priced into the price, and it opened for a reason at a specific level, right? So that's why those specific highs and lows is also pretty much therefore in terms of my methodologies holds more liquidity, right? Those highs and lows holds more liquidity compared to other highs and lows in the markets, right? Meaning we can use those to our advantage, meaning when price sweeps those, aka become more liquid, we know that when the market becomes more liquidity in markets equal change, or higher probability of a change in markets, since higher liquidity also allows for bigger orders to come into the markets, and bigger therefore change. If bigger orders comes into the markets, you have a higher probability of them actually changing the direction of the markets, because they ultimately can change the direction of the markets. Hopefully all of this makes sense for y'all. I'm just trying to explain for you guys as easy as possible. So, you know, it does not really become that hard for you to understand specifically the things I'm talking about. Right. So that's time-based liquidity. Now I'll show you some chart examples of this. So some chart examples of this, as I said, is just previous daily highs, previous daily lows, and it's just previous daily highs and previous daily lows. So for example, this right here would be time-based liquidity. This would be time-based liquidity, right? This would be time-based liquidity, and this would be time-based liquidity. Now when we open up right here, so if we were trading this day right here, this specific day, I'm just gonna do this. If we were trading this specific day right here, this high and this low would be time-based liquidity. I've already done a video on time-based liquidity specifically, but now I just talk about my methodologies in a way, like how I think. But you also have previous week highs. So if you were trading now open here, the next week, Monday, right? This high and this low would be time-based liquidity. And the previous month here, in that case, you know, you have this time-based as time-based liquidity and this low as time-based liquidity. Notice I pretty much target this low, right? And we have already swept this high, so that could be something, right? And we are more or less looking for this month to close bearish towards the downside. That's at least what I'm looking for. So that gives me some insight, right? Some insight into what we're looking at. So that pretty much sums that up, I guess, in terms of my thoughts and how it works, etc., how I believe it works, and all of that. And as I said, it's just to an extent. Y'all have to figure out to what extent it is and to what extent these concepts works for you. Since, of course, developing your own methodology is the perfect thing you can do. All right, not following anybody else and just following your own um, theories, right? And your own, pretty much what works best for you in a sense. Since if you only work with the things which works the best, of course you're gonna be the best, right? Because of course everybody's different, a little bit different at least. Yeah, shall we go into talking about a little bit, because we have mentioned bias so much and analysis and, you know, models, etc. Now, my methodologies, of course, is something I incorporate in all of these specific areas, right? But a lot of people cannot distinguish between a bias established in the market, like the direction you think the market is heading based on things, and of course potentially also based on probabilities, and a probabilistical market model, right? You're pretty much trading on your bias, right? And a lot of people cannot distinguish a bias from a model, right? Potentially some people is just trading seamlessly or aimlessly at the or on their bias, right? Meaning trading blindly, I would personally say that is and that is just trading intuition based, right? Since you should not let your bias determine your profitability. Instead, that should be up to your statistical model, right? So if you have an already established bias in the markets, right, a directional, you know, where you're overall thinking and we're going to base your model upon, right, you then need to have a model which you have already collected data on, which shows you overall, in a sense, where you should execute in that given bias, like the market conditions you should execute on and how you should execute, right? So personally, I could just go into detail about my model specifically here a little bit. So I'm just looking at specific highs and specific lows, like time-based liquidity get taken out in the direction of the fundamentals. That's simply my model, if I'm honest. And so right now, I'm just specifically looking for liquidity sweeps to the downside here. And that's simply my model, right? And I know specifically that this works majority of the time. And so it won't stop. I potentially could take 1-2 losses, right? But ultimately, I'm basing not my model on my bias. I'm basing it on, I'm making it independent of my bias. Since my bias, I can believe something in the markets, but then I can also execute on the belief. But I don't execute on the straight belief, I execute on the model, which is potentially then based on bias. But you have to make those two independent of one another. Those two cannot be, dependent on one another. Like I can trade my model without the bias, because my model gives me specifics in the markets I need to look for, which means I can pre-plan for the things of an occurrence, right? I can always, in a day, right? Some people are looking for trades. I never look for trades. I plan for trades, right? And so every single day, right? like this is pretty much having a bias based on what your thoughts, and having a model then independently based, right? Since a lot of people are just thinking something is going to play out, but they don't necessarily know if it's going to play out, or they don't know the probabilities of it playing out. But knowing it will give, or at least gave me an edge to be comfortable sitting and planning for trades, right? So I actually plan out the trades I'm going to take throughout the entire week based on what my model tells me I should do. Um, and some people are just sitting there and waiting for trades, like they're seeing something in the markets, oh, this looks good, and they're taking it. I don't sit there and wait for things which looks good. I think, or I pretty much pre-plan the trades I'm gonna take. So I think, we're gonna sweep this, we're gonna take out this, and then we're gonna trade it, etc., etc. And I'm planning for the sweep every single day since I know the probabilities behind it. I don't know. I don't know to an extent when it's gonna happen, but I know it's eventually gonna happen, and I know um, the occurrence rate of those things playing out, right? Which makes me a little bit different from normal people. Anyways, I think everybody have grown a little bit tired of my yap, but this just goes into detail about pretty much how I trade, why I trade, and my methodologies behind the things I'm using. So as you can see, I don't necessarily have any, fair value gaps printed out on my charts or anything like that, since I don't believe that's the thing which moves the markets. I believe the liquidity, and where the liquidity gets taken out, is which moves the markets, right? And specifically the fundamentals behind the markets. That's overall what I'm specifically focusing in on, right? And that's the thing I'm basing my analysis always on, which is a little bit different compared to other people, which would just say, "Oh, this was this specific fair value gap, which just turned the markets." I would give you guys an homework here, um, which of course will help you to actually start understanding if your things is actually based on probabilities or if it's not based on probabilities. But I would definitely like everybody here to simply go in and print all ICT's concepts, right, except for liquidity, on the charts, and you'll see there's no the PD race specifically don't tell you the direction of the markets. If you print out all PD race, all FVGs here, inverse FVGs, uh, Reaper inverse value gaps, breaker blocks, order blocks, one more, propulsion blocks, rejection blocks, etc. etc. You have so many more, right? You have so many more wicks, all of that. You're gonna see just the charts being clouded, and I noticed that, right? Because previously I just based my model on those things as well, right? But when I started noticing that, I started minimizing and minimizing and minimizing until I pretty much tried to find the root cause of what actually made my model work. And I pretty much took away everything which I did not have statistics on working, right? Real statistics, like real, collected data on working. And I only focused on the things I knew worked and that I could collect data on. Um, so that would give me a statistical edge, right, over the markets. Since with PD race, you could of course collect data on the specific PD race, but it does not really give you the direction in the markets. From the things I use, I personally always get the direction of the markets, and it only tells me one direction of the markets. It does not tell me two things. It does not tell me, oh, some days it's uncertain. I always know where the markets is going statistically, but of course, sometimes it does not play out. That's what's really important to note. That's what's extremely important to note, by the way. Which is why I don't have 100% statistical edge over the markets. I have to an extent an edge over the markets, but it's just to an extent, by the way. Anyways, let's go into the in-depth analysis here. So starting off, everybody, we're just gonna go into the news events. I'm just gonna minimize this right here. So starting off, everybody here, we're pretty much gonna go in here. We're gonna go into the calendar here, and we're pretty much gonna go into this upcoming next week right here. And so if everybody just look at this, you'll pretty much be able to see straight away that we're pretty much facing here on Monday an Euro bank holiday. We have French and the German bank holiday. Personally, I think, of course, this will ultimately lead to a little bit less volatility in the markets, but I think it's overall still going to be, you know, good in the markets, I would say. I don't think this will pose any major problems, even though these are two uh, of the biggest economies in the Eurozone, right? I think, it will be totally fine to trade Euro USD, GBP USD, and the rest of the markets here on Monday as well. So you don't have to worry about it. But just note that we could go into some consolidations, right, throughout the day. So that's just really important to note. Really important to note, guys. Now, second day, let's go into Tuesday here, everybody. So on the Tuesday, what we're specifically looking for is just pretty much the market to have real good price action. I would personally say we usually have good price action during CPI, PPI weeks, right? We usually just do what we do and we get some volatility into the markets, and volatility is something we like, right? If it's to our side. Now, personally, I think we are to expect a higher CPI, right, this entire week, or higher PPI as well, because I think we're gonna have a little bit higher inflation. I think this will definitely be seen now in price, which will be really freaking interesting, seeing how the market reacts this week. Now I'm going to talk about specifically why I think we're going to have a little bit of a higher core uh, price index, or just a little bit higher inflation. Overall, CPI is just inflation data. It's the most important data right now. And we can possibly even potentially trade this. We'll see, we'll see. But if the market structure is good, everything is pointing one direction, I think we can even potentially trade a CPI here event, or I'm gonna potentially trade a CPI event here. We're gonna see, we're gonna see. But like I said, Tuesday is gonna be good. You're gonna not have any consolidation or any major consolidation, as at least here on the Tuesday. I think the Tuesday is gonna be the best day of this week. Then of course we have the Wednesday, and I think I'm gonna try to position myself in a trade here, so I can actually capture the CPI event, because as I said, I don't trade like 10 minutes before, 10 minutes after CPI events. I trade either, some hours before the CPI events drop, right? Or I position myself already previous day in a trade, and then I just hold it throughout the next day. That's something I potentially do here, and that's something I think about doing this week. We'll see how it ends up playing out, right? But we're just gonna see it, right? Yeah, everybody's seen this as well. That's good. And now, of course, on the Thursday here, we actually have the PPI, and I think the PPI here will also be bullish for the dollar. So I think both the CPI here will be bullish for the dollar, and the uh, PPI here will be bullish for uh, the dollar, right? So both DXY upwards, I think. Now, why I think this is just because I think, overall the tariffs, right, is going to have some implication on inflation. And I think, since putting a tariff on a country pretty much will drive up prices, since those companies needs to pay, a higher price on importing the consumer product. The consumer product, I think they're gonna lay it over to the retailer, meaning raising prices of the consumer, right? Which just drives up prices overall. But it's not good price spikes. Like inflation overall is good, but this is not a good inflation. This is a bad inflation, since this is not an inflation caused by money in the markets overall. This is an inflation caused by tariffs, which slows the economy. So it's like inflation, but also deflationary at the same time. It's crazy. But we'll see, we'll see. But I think the Federal Reserve is going to look at this closely, and so you're going to have the rest of the markets moving very carefully when you add this CPI this week entirely. But then you also have Friday, and I think Friday is also going to be amazing. If I'm honest, it's just going to be amazing. And this is human inflation expectations and consumer sentiment. I think these are also real important actually, but it's tradable, right? You can trade through majority of these news. I would just skip trading 10 minutes before, 10 minutes after them, and instead I just, if you see a good trade, potentially consider taking it. But just consider there's a high probability this week that we see a higher CPI and higher PPI, or more bullish dollar this week, um, since we are expecting a higher inflation. But we'll see, we'll see. And you can see the forecast here as well. The forecast is already pricing this in. So we'll see if if it's higher than the forecast or if it's just like the forecast. Personally, I think it's gonna just be like the forecast, and it's a higher inflation. So overall, potentially, it's another 2% part target. So I think it's gonna be considered bullish. But if we get like a 2% inflation here, that's gonna be mega bearish for the dollar. So I just want to show you guys two sides of the coin, right? But I'm expecting higher USD here throughout this entire week. But we'll see, we'll see. So then let's go into actually the American dollar here. So just going into the American dollar and just showing you guys here. I've already looked at the COT here for this week. We looked at it a little bit yesterday. I also published a call for that, so you can watch it. I'm just gonna actually send it to y'all. I'm gonna do it just right here. Wait, just 1 second here, guys. I'm just gonna forward a message to you all. But if you go in here, there we go. Here we have it, and now you guys will have it in the chat here as well. So this is pretty much how I read COT, seasonalities, and dark pools to confirm my trades. It's just the first call in my methodologies. This will be the second one. This is just talking about how I see liquidity in the markets. As I just said, I'm trying to organize all the calls, like I said. But yeah, this is very important if you want to read COT, etc., etc. So please just make sure to watch it if you like what I'm pretty much doing here. Now we can go specifically a little bit into detail about why I think we're gonna go up. And so you can see bonds has collapsed, or what has collapsed. We're pretty much very low here. Yields are very freaking high, which is pretty much makes me believe that we have this rate imbalance, right? Which I've talked about. We have the interest rates still really freaking high. Now, at least, I think we're at least gonna go to then halfway of this dollar price, since the yields, or I mean, let's just talk about interest rates. We don't need to talk about yields, but the yields also show that we should definitely go potentially up here. But I think the yields is gonna go lower while we go higher for the dollar, meaning gonna like balance out here, and then it's gonna correlate again, right? But for interest rate, at least you can actually check this out. I'm gonna actually print these on the charts here, so everybody's just able to see them. So don't worry, I'm actually gonna plot this on the charts. So as you can see, this is the interest rates. I think everybody's able to see this now, hopefully at least. And as you can see, they have just stagnated here, and I think they're gonna keep being here at this level for long time, right? Not long time, but I think like next month as well, right? I don't think we're gonna see any interest rates cuts. And as you can see, like when we were at this 4.5 level, that was pretty much, uh, I don't know specifically, but it was like 2023, I guess. And 2023, I think we were priced at least here. Right? You can see it was pretty high right here during the entire 2023. And on average, we were located here, as you can see, at this level right here. And so that leads me to believe that we're going to trade to this level here. Once again, since this interest rate is just the lowest interest rates. And I think that we have even potentially a little bit higher interest rate, because measuring with yields, you can see that the interest rates for the yields has been even over 5%, which is just crazy. And that pretty much is an inverse yield curve. And what that leads me to believe fundamentally is that we are to see a higher dollar. Now, what confirms my theory, what establishes the theory, is just if the central bankers is thinking the same thing as me. Now, if they're thinking the same thing as me, we should ultimately see a bullish hedging program. And that's exactly what we have actually seen. So if you go into COT after this call, that's your homework as well. Check COT, you'll find that the COT has actually, gone past minus 10,000 line, and we're actually more or less at positive numbers now, which just leaves me to believe that they're positioning themselves for bullish dollar fundamentally, right? And overall, I think that's where we're heading. We're heading for this strong liquidity up here, while we've had meme prices before. And I think, that's where we're potentially going to reach. Now, this has little bit implications of other currencies. We just wait 1 minute here. Now, since we have established this intermediate term bias here, right, of an bullish dollar ultimately, but I think higher time frame we're gonna long term we're gonna cut the interest rates, right? The Fed is gonna cut the interest rates. So I'm looking for something like this, and that also in a structural manner. Now you possibly understand this. That also confirms our theory, right? Structurally as well, since for them to make major changes, they need price to be more liquid. Since more liquidity means they're having a higher probability of filling more orders at those specific places, meaning a high probability of changing the market's direction. Now think about it a little bit. Do you think it's a high probability of them filling orders here for a lower dollar, or here for a lower dollar? Because long term, we know that they're going to cut interest rates, and when cutting interest rates, you're going to see a lower dollar. Now, for them, potentially to hedge better, right, against uncertainties, they overall have a higher probability of filling their orders here compared to here for a lower dollar. And so they're going to take price here for them to have this higher probability of filling their orders. And I think, this just confirms our theory. Like, once again, structurally, in terms of my methodologies. Hopefully everybody understood that as well. So yeah, we are just looking for high prices. You saw my analysis here. Now, my analysis is not the same thing as a model. I need certain things to play out before I enter a trade. I cannot just see, oh, we've seen high prices and so I'll buy. Of course, if I was swing trading, I have possibly something I could do, but I'm not really swing trading. I'm trading intraday. But having established bullish buys here on the dollar just gives me comfort, since now I know what I should look for structurally lower and pretty much the direction I'm waiting for the markets to deliver to. Now looking at the EURUSD, since the DXY overall, is the world's reserve currency, having a lower dollar or a higher dollar here specifically, which is what we're looking for, a higher dollar, right? Um, this just gives me comfort in looking at lower prices for example, hedge Euro USD. So I'm bearish on USD. Now, hopefully you have that established now. And hopefully you know what a structure manner and what I'm looking for structurally. I'm just looking for low prices structurally, week to week, day to day. And so on an basis like the 50-minute or 5-minute time frame, right? I'm just waiting for time-based liquidity sweep towards the upside to get taken out, and then I'm gonna short. That's simply my model, right? That's simply the thing I'm waiting for. Now I'll take some questions. So I'll pretty much So I'm simply gonna mute, like I think I did not even say it because it was so laggy. But I'm simply gonna mute for like 1 minute to pretty much make y'all think a little bit of the things I've already said, right? So you hopefully at least can come up with some questions at least. If you don't have come up, if you have not come up with any questions, I'm gonna round off this call since I have some things I need to do. But hopefully at least appreciated this call. Now let's see if you have any questions.